Elfreda. I'm the Client Portfolio Manager here at Alphinity Investment Management. Today I have Jeff Thomson with me. He's one of our global portfolio managers and he's recently been to a very interesting research trip to Europe. So today we will be diving into some of the highlights from that. So Jeff, as a starting point, please share, where did you go?
Thanks, Elfreda. I came back from a really interesting 2-week trip across Europe. I visited 5 different countries. I started in Spain, went to Italy, Germany, Switzerland, and then ended up in the UK. Saw a wide variety of companies. I think it was 24 in total, across a really wide range of different sectors and subsectors. So, trains, planes, and automobiles. It was an exhausting trip, but a very rewarding one. Yeah.
So we know that things have recently been picking up in Europe and lots of fiscal stimulus and so forth. So tell us, just from a top-down view, what were some of the higher level key takeaways for you?
Yeah, it's difficult to summarize, I guess, just given the wide variety of different countries and sectors I saw. But I think if there was one single takeaway was really, I think if I could talk about the European banks, I think I saw several of those banks. I saw several European financials generally, and generally they're in really good shape. The sector has performed really well already. We already have a really good investment in the portfolio that has benefited from this, CaixaBank, which we can talk about. But I did come away with a sense that something has really shifted positively in the sector, and that performance may well continue. And I think if you had to summarize it, it's really more than anything else about that shift away from deflation and 0% interest rates into sort of a more reflationary environment. And I think it's hard to overstate just how important a driver that is for the banking sector. I think layering on top of that, you referenced, German fiscal stimulus, steepening the yield curve. So those are 2 really important macro drivers. And then I think from a growth perspective, I think I was quite struck that certainly no one is euphoric, but I think there's a sort of a quiet sense of confidence that Europe can get through this phase. I mean, I think people are eyes wide open about the challenges regarding geopolitics and tariffs. But again, the growth and the credit cycle seems to be in quite a good place. Employment's quite strong. The regulatory environment, I don't want to use the word deregulation. It's probably more like a regulatory simplification, but I think that tide is probably peaked there. These companies generally are now earning well in excess of their cost of capital. That's it's been a long time since we can say that. Returning large amounts of capital to shareholders and not expensively priced. So I think all in all, I came back quite constructive about the sector.
Very interesting, and nice to add some positivity to the European story there. So let's take a closer look at our portfolios and what this means for our portfolios. I know we've recently added quite a few European names. So one of the banks, CaixaBank. What did you make of that one specifically?
Yeah, within, as I say, a broadly constructive sector. We have for some time believed Spain is a particular call out. If you recall, Spain was the epicenter of the global financial crisis back in the day, sort of 15 years ago now. But it's spent 15 years really rehabilitating itself. I think generally the consumer and corporates in Spain are in a good place, having deleveraged. Growth is returning quite strongly to Spain. It's, I guess, the tourism capital to some extent of Europe. Has been a real success story. And within that, Caixa is a really high quality business that's really exposed to many of these trends. So as I say, the top line, some headwinds in the short term from lower interest rates, but fee income is growing. There's some scope for operational efficiencies. The credit cycle, as I say, is benign and really returning capital to shareholders. So trading at what we regard as very attractive multiples with a strong dividend yield supplemented by buyback. So we think that remains a good investment for us.
Very good. Well, thank you very much, Jeff. And for more information, have a look out for our note on the feedback from all the members of the global team on just their recent trip. So thank you, Jeff, and thanks for listening.
Thanks, Elfreda.